Hello, everybody out there, and welcome to the Coach's Playbook on the 15th of July, 2020. Dan, where is Dan anyway? He's on vacation somewhere?
Yeah, he's taking a little bit of time off.
Said he's doing yard work.
Yeah, that's what he
Doing a
said.
yard work vacation. Anyway,
Likely story.
I'm Jack, and I'm joined by Mr. Hoagland, Migeronimo, and JD, the Dancing Bear. Today, we want to talk a little bit about a topic we're going to call the evolution of a trader. We'll find out what that means. But first, Mick, do you have a shout out for us today?
I have a couple shout outs. During the volatility in the last few days, we've had a couple traders put up some very big days. So huge shout out to Sean Buckley. He's doing great in his account. He put up over 13 grand the other day trading the NASDAQ. And then another one of our traders, Vitali, he's been regularly having $6,000, $4,000, $7,000 winning days. These guys are just brand new to their accounts this month. So really happy to see what the summer's bringing for us, and watching these guys continue to grow these accounts and trading well.
That's some good trading.
13
Really
grand a
good trading.
day. Anyone will take that. That's pretty good.
Yeah, that's nice. That's really nice.
So as a way of introduction here to the topic, a lot of people who are new to trading and starting out make some of the same mistakes that when you just learn by yourself, you're bound to do because it's just part of the process. So we were thinking that if we talk sort of about the evolution of a trader, we might be able to help you skip some of those first things that traders do and save yourself a lot of hurt right off the bat. So maybe we'd start with Mick, because you were talking about this earlier. What was that evolution like for you, and how can this lead someone who's just getting started to make better decisions?
Sure. Thanks for turning it over, Jack. Before I get into the evolution for myself, people that get into this business on day one, week one, year one, they're not the same trader that they are, after, many years of experience. So we wanted to talk a little bit about the growth here. We've got some newer traders here. We have some veteran traders here. And everybody's trading evolves, whether it's your strategy and changing that, or if it's, the time frame that you're trading on. So just know that this is a never-ending process of growth. That's one of the very exciting things about the business. Back to what I said, you're not going to be the same trader 2 years from now that you were before. Hopefully you're improving. If you are having a 2-year-long career in trading, it means that you're learning from mistakes and you're moving forward, not making those mistakes again. For myself personally, my trading changed drastically in year 1 to year 5 and after that. And it's still changing a little bit. I know when I first started trading, I was looking at shorter time frame charts. I was in and out very quickly. And I was telling the guys right before we hopped on, if I ever got a phone call, I'd be very frantic on the phone call if I had a position on, always like just a little too wired up. And, between then and now, it got to a point where I was very calm doing something else, like picking up the phone and talking to someone. So to the point where you put a trade on and you walk away, or instead of, trading off of a 5-minute chart, maybe you're making trades off of a daily chart now. I tend to lean towards the higher time frame now with things that you can hold for an extended period of time. I know that it's too difficult for me personally to pick up on the gyrations up and down throughout the day in the markets. So that's kind of where I've gone from, in and out many, many contracts to, and this is discretionary trading, just in and out many contracts based off of a shorter time frame to further out, fewer contracts, looking for a bigger piece of the move. So that's just me personally. Trading strategies are kind of, you tailor them to yourself, and as you grow, they're going to change. You wise up and find out what works for you. Early on, people are probably like myself, trying everything under the sun, trying to find out what works. And I've been less so testing new things that work for me and more so cutting out things that I don't work. So my strategy is developed by cutting the weeds out of things, and that's what's allowed it to develop to what it is now.
You brought up a couple of really important points there. The first is that there is this certain frantic blood pressure spiking energy that goes when you start putting on live trades. And I remember the first time that I really started doing that was when I was working at the prop shop, and I was 22 years old. I was filling other people's orders overnight or off their instructions. And I remember getting started and reading their sheets. They would leave sheets with sort of levels that they wanted in the spreads and things like that. And just reading it 4 or 5 times again and again, looking at the spreaders, looking back, putting it in, double checking. It was like a 10-minute process to put on a minuscule position. Now it's just more put it on, trust your process. And I think that you're right with the second part of it, talking about the short-term timeframes. Really what you're talking about there is the statistical concept. It's the name of Nate Silver's book too, of the signal versus the noise. And the people that trade on the 1 and 5 minute charts, it's too easy to get caught up in the noise instead of the signal of what's going on. And that signal is not there on the 1 minute chart. Also, you're at a huge disadvantage with a lot of these scalping strategies just because and JD and Hogue, I think, are going to touch on this. Things were different back on the floor, but just the way computer algos and things like that work now, those are the machines are the scalpers now. Your value add isn't going to be from flipping E-minis for a couple ticks. So, JD, you look like you have something to add to that.
Oh, sure. That's 100% true. There is no edge on the screen anymore for retail traders like us. In the days of the pit, I got my start on the floor of the Chicago Board of Trade. It was more of a hybrid role in the early days of screen trading. I was at a desk next to the bond pit, managing the screens. My partner was in the pit, working to get an edge that I would offset either with a scratch or make a couple ticks. And that was, high volume scalping. We didn't trade small, 50, 100, 500 lots. Even when Goldman came in with some big paper, we do 1,000, 2,000 lots in a day, So we're trading huge size in the pit against the screen. And it's just a different animal of scalping that doesn't exist anymore. Those edges are gone. You can't walk in at 4 o'clock in the morning and load up your dome, hoping that, your timing's right and you'll get that quick fill in the first sprint and maybe scalp a tick or two. It just doesn't exist anymore. And the biggest transition that I had to make was getting away from that mentality when I moved to just strictly screen trading without the edge from the pit. You can't scalp for 1 or 2 ticks anymore. If you are, you got to trade it small. Otherwise, you're just risking too much. And I understand that you have to start small in order to build up your count at first. But if you're going to be scalping, you can't even call it scalping anymore. You have to trade quick with a bias. And just won't work.
Yeah.
You have to be able to let your trade breathe a little bit before you take that little bit of profit.
It's a really good point. And speaking of being adaptable, I'm going to swap this battery out on the light. So we'll let Hogue chime in, and I'm going to disappear for 4 seconds off screen. Talk amongst yourselves.
All right. Thanks, Jack. Thanks, Mick, and thanks, JD. When I first got into the industry, it was still the Jurassic period. There were still dinosaurs roaming around the trading floor. But the iterations that I've been through as a trader have been many. That when you were on the trading floor and you were just a local trader trying to scalp out of buy the bid, sell the offer. Most of the traders that I knew down there weren't even considering looking at charts. They didn't have any kind of bias. They were really just looking to get that edge on buying the bid and selling the offer. And when I, first started working for a proprietary trading firm, that's what they told me to do. They said, go in, work the bid, work the offer. If you get the bid, try and sell the offer. If you can't sell the offer, hit the bid, rinse and repeat. It was an exhausting way to try and make a living. At the time, it was possible because we were the short time frame. We were the algos and the HFTs at that time. Now, when they came into the picture over time, they've really taken over that niche in trading, the working the bid, working the offer, and trying to be quick enough to just scratch the trade if you don't make a tick or two on it. As far as my journey, I started that way, but it wasn't too long until I was introduced, or reintroduced, I should say, to the market profile, which gave me some longer term views of the marketplace. As Mick was saying, he started very small, very nervous, but started to look at longer time frames and look for bigger opportunities out of the marketplace. And that's really what the market profile kind of provided for me. And my trade locations got better. I wasn't just looking to buy the bid or sell the offer. More like JD was talking about is, trying to trade with some sort of reason for picking one side or another, whether the reason was right or not. We're always looking to limit the risk. So, going from just stepping into the pit, trying to scalp, expanding my time frame a little bit, actually looking at a chart or a profile to look for good trade locations was a big advent for me. And as time went on, going from pit to screen, I felt as though I had a lot of friends and people that I knew in trading that had tried to make that transition before, and they weren't able to find much success at it. These were people that were great pit traders, but we were just not able to be consistent and profitable on screen. It's a little different game. So when it came time for me to make that move, I had to kind of restart. I had to relearn a few things and unlearn a few things that I was kind of depending on in the trading pit. So, as far as what Mick was talking about, you're not going to be the same trader you are today in 2 years. And you're probably going to find many iterations along your trading journey as hopefully first, become sustainable, become consistent, profitable, build those profits, and build your strategy, and be able to find the success that you want and we want for you. And I believe anybody really has the possibility to get to it if they just make some of the right decisions and make some of the right mental changes and physical changes inside of them. So, um, JD was saying you're going to have a tough time fighting or competing with the computers. They are the edge in the short time frame like that. If you trade above their time frame, if you trade outside their time frame, they're not going to bother you too much. They're the
Yeah,
providers,
that,
they're the market makers. It's just up to us to be a little bit more directional in our decisions. And the I think the edge that traders need to find today is in that reward to risk ratio. Look for the asymmetric opportunities, small risk, big rewards.
yeah, you have to have the confidence from doing your research and having a strategy that you've built to hold on to these trades, because even past the floor things, even from 10 years ago, when I started trading and we were using semi-algo strategies and things like that, there were still mindless trades back then. But even those disappear within 5 years. We used to trade these dumb trades called the 2-year basis and the 7-year duration, and they were just fade, fade, fade. If it went out of line, put on more, put on more, put on more. It always eventually comes back. If you had, and there was edge from doing that. Those sorts of trades don't exist anymore. It really is. Things have become so sophisticated between the AI and the algos that you really need to be thinking in a way that a computer doesn't, or that would be very difficult to teach a computer to do. And those are the higher time frame strategies. Those are you can't trade off the news. You can't market make as a human, really. So you got to figure out where your niche is and how best to exploit that. I think that's the evolution that everyone that's going to find success going forward, that's what they're going to have to do. So, Mick, is there anything else that you want to add beyond time frames, or is something that you see as more of towards the not the end, because we're always adapting as traders, but kind of as you've been trading for a long time that you see people doing?
Um, One of the best pieces of advice that or comment that I heard was, pay attention to the higher time frame. The higher time frame's in charge. And for people who are day trading, that still holds true. You don't have to. You should be paying attention to the higher time frame. You can still have a directional bias off that, but the higher time frame's in charge. You don't want to be caught missing the forest while you're staring at the trees. You know what I mean? So I think it's important for people to move to that higher time frame. It's where I started to find you know more confidence in my directional biases. Um, I don't, I think we covered what we wanted to cover here. I could go on and on about trading and, developing yourself as a trader, but I don't really want to do that. I think we wanted to just, let people know that, you're going to change as a person. The more screen time you have, you're going to change as a trader. What you do is going to change, and that's a good thing, because the longer you're in it, the better and more fine-tuned you're making yourself. So learn from your mistakes. That's how it worked best for me. Just trying to cut out what I was doing that was hurting me, and that's kind of what's developed what I'm doing currently.
Yeah, I think that that's a great way to look at. Look for that signal. I think that's what we can kind of distill what we've talked about today is, as a human, you're good at finding that signal. All right. The best computers, they're just trying to, the best AI programs are trying to do the work to almost think like a human and develop what that signal could be. All right. But they're still just taking external stimuli and putting it out there. If you can train yourself to avoid all the nonsense that's around there, that's when you're going to start finding success. So, Hogue, did you want to give us a quote to take us home?
Sure, and this one goes right along with what I was going to say is, you know, the machines are machines. They're doing what they're trained to do. I think that's the one thing that human beings have in an advantage over the machines is their ability to adapt and to adapt quickly. Creativity is certainly going to be part of your trading as a discretionary trader. And I love this quote: "Nothing will stop you from being creative so effectively as the fear of making a mistake." That's
Mm,
John Cleese from
love John
Monty
Cleese.
Python.
Yeah, Monty Python's great. Yeah, anybody who's good at anything, you got to go out there and fall on your face occasionally and be okay with that.
Absolutely, 100%. Yep, just fall gracefully.
Yeah, just don't fall through the floor 50 levels and, the trading equivalent to that we have seen done too many times.
Yeah.
Well, so with that, everybody out there, we're probably posting this on Thursday, right? So get ready for the weekend, guys. Have a great time. Stay safe, and we'll be back next week. Hogue, you want to sign us off with the classic saying?
The classic, get out there and profit, traders. Trade well.
We'll see you guys later. Bye.